here with Maury Fertig, a longtime investment professional who co-founded his firm Relative Value Partners in 2004 after a long tenure at Salomon Brothers Citigroup. He's also a frequent contributor to Forbes magazine on closed-end fund and other investment topics. Maury, from your perspective, what's the most important trend or market factor that long-term closed-end fund investors need to consider?
Well, the biggest part of the closed-end fund market is the municipal bond space, and that presents a lot of opportunities and risks. And right now, as we enter a period where the Fed is raising rates, there's a lot of headwinds facing that sector, but it also presents nice opportunities. So we're weighing the risks of how fast the Fed moves, how fast interest rates that the funds have to pay in terms of leverage cost, how fast those go up, which ultimately affects the dividends they're paying. We also have the prospect since the election of potentially lower taxes. That makes munis somewhat less attractive. And then finally, they're very long duration assets. So they're very sensitive to longer interest rates. And if rates move up modestly during 2017, they could do fine. But if we have a rapid rise, such as the type of movement we had in November, it could cause some material price movements. So I'm a little concerned about that going forward, but it's something we're watching very carefully for 2017.
Are you concerned about the rising cost of leverage for closed-end funds?
Yeah, I am concerned about the rising cost of leverage, and it's most particularly acute in the municipal space, where we've seen a much sharper rise in rates for funding those funds. It is an issue in some of the longer duration funds. I would again stick to short duration funds where the sensitivity isn't quite as extreme, but ultimately you will see a pressure on dividends in 2017, and you will see some cuts, but we're obviously moving from very lofty levels to begin with.